our fourth lecture out of 4 for the second exam. So our next exam should be next week. We are going to be looking at setting selling prices and how you may go about doing that. There are typically 2 options that a company would use to set their selling prices. The first option is when you're selling something that is very common and the price is already set. So that's option 1, where you cannot deviate much from your competitors. Think of gasoline. Even a 1 or 2 cent difference could sway your customers to the other gas station for a lower price. So if that's the case and you can't negotiate the sale price, what you have to make sure you do is keep your cost plus the profit margin you want to achieve. Make sure that when those 2 are added together are less than or at least equal to your selling price. So if you sell something for, say, $60 and you want to have a profit of $10, 60 minus 10 tells us that we have to keep our costs at least $50 or below. We'll take an example of that here in just a second, but I wanted to introduce then the second option, and that's when you sell a more unique product and you can vary with your price. So therefore, setting your selling price is the last thing you'll do. You will figure out what is the profit you want to achieve. Then you'll figure out how much costs are involved to make your product, your unique item, and then add your profit plus your cost to then get your selling price. And usually that will have to be within a relevant range, but then you can also set your own selling price. You don't have to be exactly what everybody else is. So that's called the cost plus pricing. And we're also going to look at it from the service standpoint, which is called the time and material pricing. And I think that may be the most relevant, as we'll see towards the second half of the lecture here today. All right, the first one, it's probably the easier one of the 3. We'll say there's 3 things here we can do. The first one here is when the price is already set. Think of gasoline. We already know what this number is, the predetermined selling price. We already have an idea of what we want our profit to be. So then the final piece is just, what do we have to keep our cost under to get to that point? So costs are going to include everything, because when we set our final sell price, that's going to include the factory, but also any other period costs like selling expenses. So let's look at this example. If I have a $15 price and I have a good idea that I'm going to sell 150,000 units, now that is very important. We do have to have a good estimate of our number of units being sold. Otherwise, our figures are going to be well off if that 150,000 isn't very relevant. Now, we spent $1 million to get our production up and running. We spent it on research and development. We spent it on getting buildings, whatever it is, machines. And we would like to have a turnaround this first year, if possible, 30% on our investment. And so what we need to then figure up with just that limited information, what is our total cost that we can get to and still get our profit? And what is that cost on a per unit basis? All right, so there's 2 ways to solve this. And I think the easier way is the first option, but I'll show you in both ways. If you haven't already, I would go ahead and pause at this point, try to figure this one out, and then I'm going to walk through the answers, even though I've already shown them to you. All right, so the first way to solve this one is let's turn everything into a per unit basis, which is what our sale price. We know we want to sell it for $15, and we think at that price we'll sell 150,000 units. So let's break everything down. Let's break our cost and our profits also down into per unit. So our profit, if we want to make 30%, which was probably pretty high, but we'll keep it at that for now. 30% says that's going to be 300,000. And if I want to spread the 300,000 over 150,000 units, 300,000 divided by 150,000 units is $2 a unit. So then I can come down here and make this very easy, I think, income type statement where you take your sale price minus your cost to get your net income. Well, we now know two of the three numbers, so we can solve for the third one. $15 minus what will give me a $2 per unit profit. And so we can easily then figure out what this one is, $13. Our costs need to be $13 per unit or lower to achieve what we want. Now, for total cost, that may be easier to look at from the management point of view instead of $13 per unit. Total cost, all we need to do is take the $13 times how many units we're going to be making. And that's $1.95 million for total cost. Now we could do this the opposite way, turn everything into total costs. If this way didn't make as much sense, let's see if the second option does. So we find first, if we want to take everything into total cost, we figure out how much in total sales am I going to bring in. If I sell 150,000 units at $15 a piece, 2.25 million. Now we take the 2.25 million, subtract out what we already figured was our profit. So when you take that, here's your total cost, the same thing that I got up here. We know that our total costs have to be at or below 1.95 million. And then I can simply work that backwards and take the 1.95 million, spread that out amongst 150,000 units, and we're looking at $13 a unit. So two different options to get to the same final answers, our total cost and cost per unit. All right, so setting a selling price isn't all that difficult. The hardest part is figuring out how much profit are we going to need to make and what are all those costs going to be. That does become something that becomes a little bit more problematic when you're actually doing a real business. In these type of situations, I give it to you, so it makes it easy. But in the real business, it's going to be a little bit tougher. All right, let's look at this second option. And this one, I'm not going to give you the answer just right away. I want you to take a minute and try to figure it out. I think that's going to help you learn this the best, is when you actually try to solve it instead of simply what I call copy and paste. You see my answers, you write them down, you're not really knowing how I got them. If you try to figure it up yourself, it'll really help you learn this material. All right, so this second method of doing setting selling prices is when you have more unique items and you can set the sell price. So it's still the same type of formula, except now we're going to figure out, think of this as our number one item that we're going to figure up. We're going to know how much markup we want, our total costs. We're going to then determine how much our actual costs are. And you could maybe do these backwards. This may be 1 and this may be 2. But ultimately, what we want to get to is what is our third item, the selling price. That's the third thing we're going to find. So I'll first off give us an example on this one, and then we'll work our way through to solve it. But I want you to try to solve it first, and I'll give you a couple of hints here as we go through it. So we're going to be selling these baby monitors, and we think at the sell price that we are going to be in the range that we're going to offer. We don't know exactly what we're going to sell it for. That's what we're going to figure. But we think we can sell about 20,000 units. Now that's going to be very important, as you'll see when we get to part 2. If this number goes up or down, that's going to really affect our price, our sale price. The company would like to earn $600,000 on their product. Okay, so we come down here, I give us the variable costs to sell 1 unit. And it came out to be, after I figured everything, $109. So we know we can't sell it for anything less than $109. That's just going to be at the bare bones, not even, that's kind of like at the break even, but not really, because I'm not even factoring in my fixed costs. So then down here, I've got my fixed costs, and those are always stated in a yearly amount, because those amounts per unit are going to depend on how many units I make. If I make 20,000, that's going to be a certain number. If I make only 10,000, then that number is going to be different on a per unit basis, and we're going to see that. So what I would do as you solve this one is, since I already have this broken down into per units, go ahead and start breaking down your costs into per unit based on this 20,000 and the profit on a per unit basis. So take the next couple minutes, pause the video, and determine what you think you would sell it for, then we'll go through the answer. All right, here we go. First thing that I would do is, again, determine our per unit basis on these fixed costs, knowing that we expect to sell 20,000 units. So the manufacturing piece is going to be $17.50 we need to tack on. The selling and admin would be $9.50. So my total cost, variable plus my fixed, I'm going to have $136. Now the last thing I need to do is then figure up on a per unit basis, how much profit am I going to tack on? And I expect to tack on $30 per unit if I divide the 600,000 that I expect to make over the 20,000 items. So when you take the 136 plus the profit, I would hope to sell my unit for $166 a piece. If I sell all 20,000, I will reach my profit level. Now, on the second part of this problem, I want us to be able to see how much of a difference does the total units really make. So if we go from 20,000 now down to 10,000, I'm making less items, so I'm going to have to sell each item for more to still hit my profit goal. So now take another 2 to 3 minutes and solve the same thing, and let's see how much the price has to jump to get to our with only 10,000 units. Okay, let's look at this. Now my price jumped from $17.50, it doubled because I'm selling half as many products. Same with this one, the selling, and the same with my profit margin. My profit margin now says I need to make $60 on a per unit basis. So my total cost did jump. Now it didn't double because my variable costs are going to always be the same per unit. But these final two numbers did double. So now I'm up to 163 on a just cost basis. Tack on the profit, I'm all the way up to 223 compared to 166 before. So knowing how many units I'm going to sell makes a huge difference. We had a $57 extra increase in price to cover those fixed costs and that profit on those fewer items. Now the final piece of this little one is I wanted to give us an idea of how we do the markup percentage. If you remember back to Accounting 101, I had usually given you the actual inventory price, and then let's say it was $10, the cost for us to buy the material from somebody else. If it was $10 and I wanted to mark it up 100%, I would then sell it for $20. If I wanted to mark it up 50%, I would sell it for $15. Remember, you take your cost, the formula, the real easy formula was cost, so $10 times, and then in parentheses, 1 plus the markup, and the markup as a decimal. So if it was a 50% markup, it would be 10 times 1 plus 0.5, so 1.5. 10 times 1.5 is $15. Now, this is just a little bit different. Now I know what I'm going to be marking it up to. I'm having a $30 markup. I want to know what it was the actual percentage. What was my markup percentage? On the first example, if I marked everything up $30 and my total costs were at 136, well, that means I marked it up 22%. And let's go ahead and prove that using our Accounting 101 formula that I just talked about. So we take our cost times 1 plus the markup as a decimal. So in our case here, it would be our cost of 136. Pretend like in accounting 101, that's what we bought the item for. And then we simply multiply this by 1 plus the markup, so 1 plus 0.22, so 1.22. When you do the calculation there, and I'll bring up a calculator, I think you'll be able to see it. 136 times 1.22, and that does give me my sale price within just a few cents, 165.92, or rounded to 166. So this tells me how much I'm actually marking things up. 22%, that's not that high. All right, let's move on now to our, what I consider maybe the most realistic, because it's something that you may do if you start your own business and it's not actually making inventory in some factory. If you start a business and you're in the haircut salon, you're in a doctor's office, repair shop, whatever it might be, you've got to find a way to know how much to bill your customers to make a profit, but not be gouging either, where you're still going to bring in some customers because you're not too high. So on this one, I think it's good. We're going to start off with an example, and then we're going to explain how we work down through the example. So the first one, the labor hour charge, this is going to be on our, what we're going to see in a second, our direct labor and any of our selling and admin costs. This does not include the factory overhead labor, like a supervisor or some other maintenance type person that is over the whole factory. Just the direct labor and any selling and admin will do labor. Everything else is factory overhead, and therefore we're gonna, so this would be rent, this would be property taxes, different things along those lines, all those other office type expenses, because remember here we're looking more of an office instead of a factory, because you can still do this. And then I want to find how much should I charge a customer if the job takes 5 hours and I'm using $700 in materials. And for this one, what we're doing, calculate the following, and let me add on here for a car repair shop. So this car repair shop is going to be putting in maybe a new air conditioner for the car, and so that air conditioner, when they buy it from them, whoever makes those, that is going to cost money, and they're going to have to charge that. So we're going to base our overhead, as you'll see in a second, on this number. All right, so the first thing I want to do is we got to break down all of our costs. This is one of the more time-consuming things if you were doing this for real, that since I give it to you, it's a little easier. We're going to need to figure out not only the costs of the hourly costs that I pay my workers, but all the other benefits. I got to tack that on as well. That's just not money that I'm going to come up with out of the air. I've got to, somehow the customer is going to have to be paying for that when I do their service. So I add up these two. It's easiest just to add them up. Our office wages, this one could go either way. And when we do it on our exercise, I'm going to have us do the secretary wage as part of overhead. But on this one, we'll keep it as part of our actual wages, and we'll find two different rates. Yeah, I think that's what we'll do on this one. Even though I don't specify there's 5 hours, we're going to assume that everybody makes about the same amount. This is kind of a simplistic problem. And then definitely these two are going to be our overhead. This is something in the factory that's going to happen. All right, so let's work off of this example. Total cost that we need to cover throughout the year, $299,000. I've budgeted $5,500 in technician. And I'm going to pause this just for a second, and I think we're going to step back and we're going to make the office wages actually part of overhead. All right, so I've updated my notes just a little bit because I think it's going to make more sense if we put these office wages into our overhead. It is kind of more of an overhead cost, especially if they're not being billed. These repair technicians, we can definitely count their hours, and we know exactly who they're working on at any point in time. With office wages, you don't necessarily know that as much, especially if it's just type secretary. They're answering the phone a lot, having people come in the door. They're working on lots of different items, not necessarily one customer for a specific period of time. So we're going to count this as more of we're going to count those office wages as an overhead. All right, so as we go through here, we're going to find the cost of 5 hours of labor, of technician labor, and then we have $700 in materials that we're going to want to space out, and we're going to use this. Well, we'll come back to that, I should say. We're going to do this in 3 parts. We're going to do the labor first. Then we're going to figure up how much overhead gets allocated per customer. And then we're going to actually do it on the job. Each job, we're going to do part C. We're going to figure out the total cost. So let's work through this one with this type of information. Let's first do the labor. That's the easiest one of all of them. So with the labor, we're going to look at the direct labor costs. And then we always need to look up then how much profit do I want to make besides just what it's going to cost me in total labor fees. So I know my total labor fees here is going to be $145,000. And I need to divide that $145,000 over how many hours I think my technicians are going to work. And I think they're going to work 5,500 hours total. So when I do that, when I do the math, oops, sorry, I need to update this. One should be 150, 145, 145,000. Space that out amongst 5,500 hours, and we're going to get $26.36. And you can see how it broke down when you did it individually. You can do it either way, just take it total, and that's the easier way. This is what I want to charge if I'm not going to make any money through the year. I'm just going to have a break even essentially. And of course, I don't want that. I want to have some kind of a profit. So for every hour, not only am I going to charge the customer $26.36, I'm going to charge them an extra $6 to make a profit. So I'm going to be charging my customers $32.36 on a per hour basis. Now we get to the overhead part. The overhead part is where we need to figure out what is something in our business that almost every customer is going to utilize. And in a car repair shop, something that we have determined for this example is every repair shop is probably going to have some parts that are added to the car. So that's how this company has decided to allocate their overhead. Depending on how much parts you add to your car, that's how I'm going to allocate overhead. So the one thing the company has to do before they even start is determine how much in total parts are they going to buy this year. So this company has decided they're going to buy $140,000 in parts. So what I want to do is I want to spread out all these 3 costs over the $140,000 in parts. So basically, when I buy $1 of parts for my client, how much in overhead costs am I going to charge them? That's what I'm doing here. So the first thing that I'm going to do is list all 3 of them, and you could just put one total if you want, but I like it better here with the overhead. Let's go ahead and space them out. If we had different types of workers, let's say we had the repair techs and then we had somebody else who actually works directly on the car, we would have the tech wage because they're going to be paid a certain amount and billed at a certain amount. And then we would have our number 2 people, whatever they are, and maybe they're billed at a higher or a lower rate. I got to know that. I got to know how much am I going to bill the customer on a per position basis. And this is the only one I have for my car repair shop. All of these positions down here, they don't work just on the one car itself. They float between different cars or do the paperwork for different cars. So that's why I put that in my overhead. All right, so when I add everything up, and I've got to update this number again. This one is this one should be 112 plus the 42. So this should be 154,000. I have 154,000 in total costs, or we can do it separate. Let's just look at it separate first. 42,000 in office staff costs, and for every dollar I spend on those repair materials, how much of that 42,000 do I need to tack onto their bill? Because essentially, somebody's got to pay these costs. If I'm a business, where it actually stops at is the client is going to end up paying not only the wages of the technicians, but they're going to have to pay all these overhead costs. So when I do that, for every dollar, I'm going to charge the customer 30 cents or 30% of their total material. Supervisor, for every dollar I spend, I'm going to tack on another 47.9 cents. And then the other overhead, all that other stuff. So when you add everything up here, for every dollar I spend, I'm going to tack on not only that dollar, because they're going to reimburse me for that dollar that I spent on parts, but I'm going to tack on another $1.10 just to cover the overhead. And I would stop there if I didn't want to make a profit. But if I want to make a profit, and I tell us up here at the beginning that I want to make a profit of 15%, so I'm going to tack on another 15% to my total costs, to the overhead. So now for every dollar that I spend, I'm going to charge the customer an additional $1.25 to cover the overhead plus my profit. Now, so that would be what I would consider Part B. Part A up here was to find the labor. Part B is to find your overhead. Now we can combine them in Part C for a per job cost. I told us at the beginning of the example, let's go back up here, that this job requires 5 hours and $700 in materials that I have to use to fix the car. All right, 5 hours of work, and I know I'm going to charge $32.36 an hour. So the first part I need to do is the labor. I'm going to charge $161.80 in labor. In materials, not only am I going to charge the $700, of course I'm going to charge that, that's how much the air conditioner costs, but I'm also then going to tack on how much do I need to charge them to cover the overhead. So the 700 times 1.25 gives me an additional $875. So in total, I'm going to charge my customer this $17.36.80. So if you're ever looking at your car repair bill, if they had a background, depending on how they do their pricing, this is how they probably should do their pricing. They may have a different way, and that's fine, but this would be a very accurate way to determine how much you should charge. It'd be neat to look at a repair shop bill next time you're there and see how they do break it down. All right, the final piece that we're going to look at, and this piece doesn't take too long, and this is very similar to what we had done last week when we can sell a little bit more stuff because we have capacity. Say we're only running at 80% in the factory. Can we sell our product in bulk at a lower price because those fixed costs are already deemed to be covered? Same thing here, except now without it being with outside the company, it's now inside the company between divisions. So between divisions, they still have to make money because each division is going to be responsible for providing a report to show how well they're doing. Are they covering their basic costs? And if that division within the company sells outside the company and inside, well, they can kind of tack on those outside the company with the fixed costs. So therefore, when they're selling to the people inside the company, they don't need to necessarily take into factor those fixed costs. So what we're going to do is find what's the bare minimum that a division within the company could sell to another division. And the answer is our variable costs, whatever those are, because we can't really change those, plus any profit markup we need to have. So if there's no excess capacity, then we pretty much have to sell it for our full price. But we'll see that there is a little bit of leeway there. But for the most part, we're going to need to sell it for the 125. But let's look at what would have to happen if we decided we have to make, in order for us to be viable, a 20% markup or a 20% profit on our variable costs. That's bare bones. So if there is excess capacity, the negotiable price range, because remember, the hardware doesn't know what our variable costs are for the software. And the software probably doesn't know how much the hardware is paying right now to get software. So the hardware company is paying an outside vendor $115. We currently charge for the similar thing $125. So the hardware isn't going to want to buy from us because they're going to pay an extra $10. But if we work together, what's the lowest the software would be able to sell their item for and still meet their goal? And then on the other side, what's the highest the hardware would want to pay? Now the hardware is the easy one. This is the highest they're going to want to pay, what they can get it for somewhere else. Now the software, remember I told us they can sell it for variable cost plus any profit. So that would be $45 in variable cost plus 20% of this. 20% is $9. So 45 plus 9 is $54. So the absolute lowest the software company would want to buy it or want to sell it for is $54 because their fixed costs are already covered. And the absolute most in the hardware is $115. So if they came together and said, hey, I'll buy it from you for $90, both places would be happy. The software would still be making money as long as their fixed costs are covered elsewhere. And the hardware company's not having to spend as much on the same product. The final thing I asked here, if there was not any excess capacity, what would be the price range? Well, technically the software company could step down all the way to $104 a unit, because if you take that 54 minimum variable cost plus profit and then add in those extra fixed costs that have to be distributed, those two added is 104. Now remember, our selling price is 125, so we're actually trying to sell more than our minimum profit range. Just in case something happens, we have more costs or we sell less units, that gives us a little bit of a buffer. So the absolute lowest is 104, and that's going to be cutting it close. Do we really want to do it? Probably not for 104. We're going to want to sell it for a little bit more than that. But could we sell it for as low as 115 or just slightly less? Probably, and we would probably still do okay. So that would be your final answer then. Somewhere in this range, because the hardware company still isn't going to want to buy it for any more than 115, what they can buy it elsewhere. Okay, with that, that ends this lecture example. You'll want to go on now, and in class we're going to do number 21 to really kind of cement this all together, and then I'll have a get out of class example. And what you should also have for class, and at the very least do before the exam, is our review number 22. I will also, the week before our exam, I'll have the answers posted for number 22. If you know number 22, you should do pretty well on the exam. Do number 22 without your notes, and then any pieces that you don't know how to do without your notes, that should be in your 1 page of notes for the exam. All right, with that, we are going to call it a day and stop what we're doing.